trade is a pillar driving the global economy, moving goods and services, driving prosperity, and creating opportunity. In recent years, protectionism, supply chain barriers, and the economic shock from the COVID-19 pandemic put world trade at a tipping point. But how will the future of trade evolve over the next decade? How will the geopolitical climate shape the new trade landscape? And how will technology and sustainability impact trade? As the world's flagship free zone and global hub for commodity trade, Dubai's DMCC set out to address these questions. Over several months, DMCC gathered data and spoke to business leaders and trade experts across major trade hubs to find answers. Here are some of the key findings. In the middle months of 2021, global goods trade was estimated at $5.6 trillion, a record. Pent-up demand saw trade in goods rebound faster than GDP, following the ease of COVID-19 restrictions, stimulus packages, and rises in raw materials prices, and important governments' restraint in the use of trade protectionism. But key global changes in the years ahead could signify the start of new economic and political paradigms with major implications for trade. Our new research suggests that the outlook for trade will be underpinned by three tectonic shifts. The first shift is lower trade barriers. Why? Protectionism has proven costly. We are at the dawn of a new era of multilateralism, underpinned by regionalization, sustainable trade, and digital trade. Economies realize that failure to liberalize and increase cross-border trade hampers growth rates, productivity, and export. More than ever, countries are seeking to be less dependent on a limited number of importers and exporters. They seek diversification and strive to reduce reliance on vulnerable sectors. In lifting trade barriers and relying less on domestic demand, we predict an increase in specialization, higher employment, and more advanced manufacturing. The second shift is soaring inflation and how policy will respond. Inflation will continue to climb, leading to rising prices. This will not only mean higher trade costs, but also supply chain disruptions, both in ports and on land, that will creep into commodities, including food and agricultural products. Tighter monetary policies and policy rate hikes will prompt tighter financial conditions. Borrowing money will become more expensive, straining the ability to get trade finance. This will have a knock-on impact on cross-border trade. This is especially true for emerging economies who are already experiencing weaker recoveries compared with advanced economies. Countries with high debt will struggle with investment. The third shift is the impact of the climate crisis. Global trade will be impacted by the climate crisis in terms of both economic shocks and opportunities. Much of the global economy is covered by net zero commitments, which could see government intervention to limit supply disruption. We will likely see larger-scale investment in renewable energy, green technologies, and green agricultural policy. The green finance boom will continue, providing an opportunity for investors and providers of environmental goods and services to scale up. Innovation will see a raft of breakthrough technologies, such as carbon capture and storage, hydrogen and artificial intelligence, which are expected to go mainstream, with exciting possibilities for climate change mitigation and trade. Adapting to a new climate and economic growth are inherently connected. As economies increase green policies, production will diversify away from commodities, broaden the tax base, and generate new development finance. Other significant pivots could disrupt the status quo in trade over the coming years. Slower economic growth in China. Oil rising to record levels, which in turn drives sharp growth disparities and political tension. And the continued rise in debt defaults, which could fuel regions of instability. More than half of low-income countries are in debt distress, threatening import demand. Although liberalized trade has been the basic premise in the last 70 years, the pandemic reshaped trade policies. But a new era of geopolitical polarization has begun, and the economic and political landscapes will shift in the coming years. After years of protectionism, nationalist trade policies will come to dominate. This will drive regionalism, bilateral trade, and global investment. This is a new trade paradigm, where cross-border investment and trade will become increasingly market-seeking rather than efficiency-seeking. Middle powers and regional trade agreements will lead to a greater regionalism. Regionalism and a new multilateralism are likely to give rise to a new trade order. How the great powers cooperate rather than compete will have a decisive influence on how dominant multilateralism will become. The new trade order will drive recovery in cross-border trade and in new sectors including digitalization and sustainability. What will define the new era of multilateralism in trade? Here are a few examples. Deeper digitalization. Digital and information gaps will be recalibrated. Increased transparency will reduce risks for financial institutions and lenders and enable businesses to build smarter supply chains. Information exchange and innovation will enhance connectivity regionally. Exporter firms that embrace digitalization will see higher profitability driven by productivity gains. Several transformative technologies are emerging in unison and are self-reinforcing, which could create a global trade supercycle. Greater regionalism. A more regionally based economy will strengthen bilateral trade and offer the possibility of a better balance of national and international interests. The need to protect countries' own strategic interests and weaknesses in specific sectors will continue to set the direction of trade, as seen during the COVID-19 pandemic. Regional trade agreements are already becoming stronger and more prevalent. Recent examples include the Regional Comprehensive Economic Partnership in the Asia-Pacific region, which is estimated to eventually account for 30% of world trade. The UAE, which signed a closer economic partnership arrangement with India in 2022, aims to sign 35 similar agreements to double its economy, boost trade and foreign direct investment. In the years ahead, cross-border investment will be under greater control and regulation, as governments attempt to restrict trade and investment flows to focus on risk mitigation and economic security. We will also see a growth of reshoring and nearshoring as economies seek to move production home or nearby. Global supply chains might become physically shorter, but regional specialization would increase, and the reduction in cross-border FDI flows would correspond with increases in intra-regional flows. Digital platforms, blockchain, and the Internet of Things will reduce costs and facilitate the restructuring of supply lines. 3D will facilitate reshoring, accelerated prototyping, and customization. Blockchain, if embraced for mass adoption, could reduce up to 80% in data entry requirements. It also helps make goods traceable, guarantees the security of payments and financing, and facilitates verification. About 4 billion paper documents move through the trading system at any given time. The digitalization of documents could increase SME trade by up to 25% and reduce document processing times by 75%. Blockchain-based trade finance models will continue to increase. This will, in turn, help unlock access to blockchain finance. This is particularly crucial with a trade finance gap measured at $1.7 trillion. The gap has had a knock-on effect on low to middle income countries, which has in turn coincided with a growing infrastructure gap. Estimates project that half of SME trade finance requests are rejected, compared with only 7% for multinational corporations. The lack of trade finance remains an obstacle to trade growth. Half of the trade financing gap is in developing countries that comprise more than 85% of the world's population, yet produce less than half that percentage in global economic input. The trade finance gap will widen in the near term. Similarly, for infrastructure, there is a need for more resources. Developing countries need to invest approximately 4.5% of GDP to achieve infrastructure-related Sustainable Development Goals, SDGs, and stay on track to limit climate change. Financing the shortfalls in infrastructure and trade finance will be crucial in the years ahead. So too will be closing the digital divide between countries and sectors to bring the benefits of global trade to all. Global trade growth is expected to remain resilient in 2022. At the dawn of a new era of multilateralism, we face a paradigm shift in trade with long-term changes underway that should support cross-border trade in the years ahead. Global value chain restructuring will continue to be a source of trade normalization and a broader-based recovery. Increased regionalism, strength in services trade and innovation, and climate politics will significantly boost prospects. Increased demand for sustainable goods will accelerate in both developed and developing economies. How government and business respond to the new paradigms is key. To learn more about how the world trade's capacity drives global recovery, please download the 4th edition of DMCC's report. Download the full report from DMCC at futureoftrade.com.